Donna Chrissy, Real Estate Talk with Agent Mom. I am Christina Holloman, Marketing Manager for Holloman Home Investments, Assistant to Realtor Donna L. Holloman with Brokers Realty Group Limited. Today we're going to discuss how to shop for a mortgage, a home buyer's guide to the right type of loan. You can find that on realtor.com if you would like to read an extensive version of how to shop for a loan. But today we'll give you a synopsis on when shopping for a home and home buyer financing for your next home purchase.
Hi, I'm Donna L. Holloman with the Brokers Realty Group. I'm also a managing member with Holloman Home Investments, which Chrissy works for. But today, like she said, we're going to talk about how to shop for a mortgage. So let's get started shopping, shall we? Shop for a mortgage that best fits your needs at least 6 months out, because there might be things in your credit report that needs to be cleaned up. You can look for mortgages, interest rate, learn about how interest rate works, how often they change, and then you can work on fixing your own credit. And for example, you may have to have a credit score of at least 760 for some mortgages, and if you don't quite fit that part, you have at least 6 months to work on that. Other mortgage, however, requires at least 660 to 680 credit score, and that also will help you get your credit in the right direction within that 6 month period.
Okay, so like cleaning up your credit score could be paying off a credit card, paying off a loan, like a car loan. What other type of ways can you clean up your credit score to get some of those points higher?
Yeah, getting your credits cards down to a nice comfortable level. Generally, mortgage companies consider credit cards to be at least 34% used. You want to have 60 to 70% available credit on your credit card, but get that down to a reasonable rate per month, and then that'll show up usually within a month or two after you make those payments down as far as possible. Then you'll see that change on your credit report. Also, keep your rent, your mortgages, your car payments paid on time, as long as possible, on time, every time. That also helps your credit score very dramatically.
Yes, not one day after, one day before, one time. On that exact date. Sometimes automatic payments help with that. If you talk to your loan advisor, like with your car loan, maybe you can ask them, can I split the payments on all of the payments so that it still reflects good on your credit score? And so by the time 6 months come and you go apply for that mortgage loan, your credit score is right where it needs to be. Now let's go into if it's not on par. Okay.
Well, if it's not on par, that's where that 6 months kind of get in there, and that's why you want to start shopping for a mortgage right now, within, the beginning of those 6 months, and that way you can look around, shop around, and then work on your credit report or your credit score between that time period. That's why you have that long span in between when shopping for a mortgage. So that's a very important step, is the first step, and that's shopping around and learning how to get your credit to the point where you can go get that loan.
Okay, so that leads us into step 2.
Yeah.
Shopping for a mortgage. When we're shopping for a mortgage, how do we begin?
Okay, so let's get started. Mortgage shopping, shall we? According to the realtor.com, shop for a mortgage to fit your needs. Ideally, you should shop for mortgages 3 to 6 months out, because banking changes over time, and sometimes interest rate can go up and down.
Oh, why is it important to find low interest rates when shopping for a mortgage?
Yeah, because normally mortgages are backed or scheduled for 30 years just to keep your payments low. You don't have to really stay there 30 years. But if you decide to make this your home, 30 years is a possibility. And the reason why you want to have a lower interest rate, because, for example, $200,000 mortgage with a 4% fixed rate will cost you $143,739 at the end of that 30 years.
Okay, so does that mean that you have to stay committed to that 30 years and that interest rate of 4%?
Well, if you sell your home, within 30 years, of course, you're getting out of it. You don't have, there's that $143,739 will not make 30 years. But this is, in this case, if you want to stay longer than 30 years, you're going to consider that $143,739 on a 4% interest rate as a big number. So you want to kind of shop around for getting a lower interest rate.
Okay. And what is another reason to shop for low interest rates?
Well, that's pretty much your best bet, is because the amount of money that you're going to be paying out in that 30 years is expensive.
Right.
If you want that number to come down, then you're going to shop around for a lower interest rate. If you want to stay in your home for that 30 years. Even if you don't want to stay in that home for the 30 years, you still want to consider that you're going to be paying monthly payments on that interest.
Okay. And with the 30 years, so say if I want to go 15 years instead of the 30 years, does that mean that my principal monthly mortgage payment is higher, or does that mean that my interest rate goes up?
Well, it's going to be fixed.
Okay.
So 15 years, 30 years, this is 4% fixed rate. You just consider, if you look at the whole number, the whole 179,000, whatever that is, and then you say, no, I don't want to pay that much. Even if I stay for 5 years,
right,
I want to bring that down. You can consider the 3%, coming down from 4% to 3% or possibly 2%. And then the way you can do that, you can go through programs like FHA, VA, some homeowner, like Freddie Mac, Fannie Mac. They may have low interest rates available to like first-time home buyers or anyone who's interested in lowering their interest rate.
Okay, and the veterans, they will have a whole first-time home buyers program as well for.
Well, veterans, there's mortgage programs out there for veterans, and that's the VA home loan. So that's other options. Most banks will offer many different options in mortgages. I mean, you have conventional loans, you have VA loans, you have FHA loans, and there's several other first-time homebuyer program loans out there as well through Freddie Mac and Fannie Mac. And you can learn that by going online and reading more about it.
Okay. And when they're searching for first-time homebuyers programs and they're searching for rates, are those usually the first-time homebuyers programs? Are they usually lower rates offered for those first-time homebuyers, or you still have to shop around within the first-time homebuyers program?
Well, those
like the FHA or the VA loans.
Yeah, like I said, those programs may offer some lower interest rates,
okay, gotcha.
But then you have to kind of shop around for it too within those programs.
Okay.
Yeah, because there's many out there. So yeah, look around.
Okay.
You might find something you like, and the price is right.
Okay, so now that we have discussed where you're at par and bringing your credit up to score, and now you're shopping for your low interest rates for the 30 years or 15 years or whatever fixed rate you would like in different home buying programs, let's go into step 3.
Sounds good. Hey, now it's time to analyze your closing costs.
So in analyzing your closing costs, what exactly is a closing cost?
Well, closing costs is the ability for the mortgage company to close your document, get those keys. And in order to get those keys, there's a process. And the mortgage process takes like your notary fees, your fees to pay the mortgage company to do the paperwork. I mean, that's all wrapped up in this one time that you're going to pay closing cost fees.
Okay. And closing cost fees, what is usually the amount of the closing cost?
Yeah, closing cost fees could be 2 to 7% of the sale price of the house. For example, a $200,000 home and 7% closing costs, which means about $14,000. So you can probably look to spend about between $14,000 to $18,000 to maybe $20,000 just for closing costs to close your loan to get those keys.
Okay, and the closing cost, is that different than the down payment?
That is different than the down payment. Normally, when you meet a real estate agent up front, you're going to put $1,000, well, the minimum $1,000 down. So that's one you're going to have to put down just to make an offer on the property. And the reason being is because the seller is expecting a ready, willing, and able buyer. So he says, if you put at least $1,000 down, that $1,000 will go towards your payment. Like if it's $200,000, you put $1,000 down up front, it's going to be $199,000. But that is different than closing costs. Your closing cost itself is to help the mortgage company process your paperwork. So that usually you want to have 20% down, and that will reduce your monthly payments. 20% down off of the $200,000. So we talked about the $1,000 minimum payment, but once you get to settlement, you can expect that 20% altogether will be put down on your home for mortgage.
So sometimes it's good to go in with already 20% down payment for any type of loan, really, for a conventional loan, FHA, PFHA, and veterans loans. Either you don't need those for those other first-time home buyer program, you don't need that large down payment, but just to break down your overall loan amount throughout the payment. So if you put down 20%, that's knocking off that price. So then the mortgage would be based on the remaining balance at closing.
Yes.
And also your closing costs will be based on that remaining balance. So sometimes it's good to have save.
Yes, it's great. If the more that you can save for a down payment and your closing costs, the better. And the easier your process, the mortgage process will go.
Okay, so on that, with the closing cost, and say you have the 14, so they'll ask for 7% of the sales price. And that 7% of sales price, 14,000. Is it any help that happens? For closing, does sellers help with that?
Yeah, there's seller assistance if you don't have the 20% down. You also can go through other programs. Like right now, this is August 26th, 2020. They have a $6,000 help with $6,000 closing cost assistance. That'll go towards your closing costs. Also, if you don't have 20% down, you're going to have to purchase mortgage insurance. And mortgage insurance is to say to the lender, okay, the insurance will cover 20% if you fail to make the payments on time. Like say for instance, you leave your house within a year or 2 years or something like that. Well, insurance will cover at least 20% down if you have mortgage insurance. But if the more money you have down, of course, without mortgage insurance, that would keep your payments as low as possible. But if you have to have mortgage insurance, remember that insurance is going to be another cost, a monthly cost in your mortgage every month.
Okay. So that sums up analyzing your closing costs. We hope that you understand. If you haven't, click like and subscribe, and make sure you comment down below, ask us any question, or inbox us. And you definitely can call and reach out to Donna, Realtor Donna O'Halloran. So this leads into step 4. So let's go ahead and process step 4. Now we're at step 4.
And you want to be mindful of interest rate fluctuations.
Okay, and being mindful of interest rate fluctuations, is it that once you have a fixed rate, that's it?
Well, when you're shopping for a mortgage and you find a mortgage, you want to be sure that the mortgage company or the bank interest rate is either fixed or adjustable. Fixed rate means your rate is fixed throughout the 30 years of time frame for your mortgage. Then there's adjustable rate. Now, adjustable rates will fluctuate over time. So you want to be sure that you're getting the best interest rate for you. Like sometimes people would go for adjustable rates because at first your monthly payments are very low. You might get a 2% interest rate, but then after 6 months or a year, it might go up to 7%. But you want to be sure you know exactly what you're getting into. And sometimes some people may get into adjustable rates because they may be investors and maybe want to go into another investment in a year. And they say, okay, I'm going to start out with a low interest rate and it's going to fluctuate, but I'll refinance in a year or two. And then others who are ready to move into their homes for permanently, they want to stay for a long time, may want to consider a fixed rate. That way your mortgage, you know your mortgage rate up front and you know your payment's going to be exactly the way it is for the life of the loan.
Okay, so that's good. And when you're shopping for low interest rates, and as far as investors goes, having that low interest rate at the start and then it fluctuates, they may sell the property by the time that next influx comes along.
Right.
But remember that your low interest rate is based on the amount of loan that you're taking out. So the house may be $200,000, but if you put that 20% down, which is like $40,000, you put that down. Now your mortgage and your interest is based on that $160,000 mortgage. So that's where that makes sense.
Where down payment makes sense.
Yep.
Mm-hmm.
So your rate that you're shopping for is times that mortgage loan that you're going to get.
Yeah.
So then that way you can start shopping and looking around, and now you're aware. If you weren't aware.
Yes. Mm-hmm.
But we're here to educate as well as serve our community and real estate needs. And that's why I work so closely with my mom. I'm learning
and she's
so
doing
much.
a great job.
I work so closely with her, and seeing her negotiate deals is pretty cool.
Oh, good.
And understand this whole mortgage thing. Also, if you're just an investor and you just want to put cash up and buy a home, then you don't have to worry about all of this mortgage and everything like that. Sometimes it's still, if you have residuals and you're like, I can buy this straight out, sometimes it's good to buy the loan anyway, purchase the loan, and that helps with your credit as well. And then you can use your residuals to pay off that loan. And that helps build credit too. But again, we appreciate you liking and subscribing. Hopefully next Thursday we'll have another tea time. So that was our 4-step process under Realtor.com, how to shop for a mortgage loan with Realtor Donna Holloman and myself, Christina Holloman, with Marketing Manager for Holloman Home Investments. All right.
All right. Thank you for stopping by, and don't forget to subscribe and like.